Let's get a move on then and focus in on personal income tax. Dhirendra Kumar is now joining in to share with us his outlook on the same. Dhirendra, let's begin first up with, any sort of bonanza or any sort of expectations that you have from the upcoming budget for personal income tax?
Yeah, I hope the long-term capital gains tax clamped on equity is abolished. And this has been the talk, but we have to wait because how the finance minister works towards reducing the tax rate in a manner that consumers have, or people at large have more money in their hand. At the same time, the target of broad-basing our tax base. So it's a very catch-22 situation, but this is something which is expected so strongly, more so as a follow-up to the rate, tax rate cut, corporate tax rate cut, and income for many people, particularly the self-employed, the way they are structured. Income is fungible. If I'm self-employed person, I'm taking money, or my company is earning money, or I take a higher salary. So differential tax rate will create a kind of friction. So because income is fungible, I can move money from here to there, and it's a discretionary thing. So how to go about how to balance it? So the expectation is that we should. It is reasonable to expect that some bonanza coming our way.
Yes, indeed. The income tax rate cuts, that seems to be fairly high as well on the wish list this time around. Just also wanted to get in your sense, Dhirendra, as to now, what some of the individuals as well should be doing in terms of, their overall tax planning this time around, some of the deductions as well that we're expecting?
No, I would say that normal organized sector employees, they are hardly left with any room to invest to save tax, because your provident fund deduction, if you are in the government, or if organized sector employee, his EPF contribution, those are all eligible 80C deductions, and the maximum that you get is 1.5 lakh, and that has not gone up for many years. I think it should be revised upward, and also I feel that the 80C provision is very crowded. You have everything there: your provident fund deduction, your insurance premium, or your public provident fund contribution, child. So broadly there are three things, and most of the mandatory things actually fill it up. So investors have or savers are left with very little option. What has emerged very strongly is the 80CCD, the additional 50,000 rupee which you can do in NPS, and NPS has improved gradually over time. So that has come as an additional thing, and my expectation will be that something is being done about these people, because these are hardworking tax-paying people, and if they are financially independent and self-sufficient, it is a relief to the government in the long term.
Dhirendra, you had mentioned that preparing for a specific event is not the right way to go about planning your investments, especially when it's a big one like the union budget. So are you saying,
Yep.
Don't really bank on budget 2020 when it comes to planning your investments? Focus on, currently the situation at hand?
Oh yes, that has always been the case. In fact, I sound like a stuck record that all these things happen all the time. You will have a union budget which will happen on a calendar. You will have something happening in the US. You'll have something happening on the oil prices. But that should not alter your investment plan or savings plan or investment plan, because most of your goals will not get altered. And if you have broadly planned things, that your long-term money is getting invested in equity, you are investing gradually, your medium-term and short-term money is invested conservatively, it is not subject to all kind of market movements, then you have nothing much to worry. 10% capital gains tax or no capital gains tax doesn't change the equation or the case for equity in the long term. Likewise, a poor market should not, you should not guide you to be investing in fixed income just because last 1 or 2 year has been disappointing on the equity market. If you are guided by those broad principles, I think an investor, most investors will be much better off by ignoring everything that is happening in the market.
Any other golden rules as to what exactly it is that you would advise when it comes to tax planning, investment analysis, ahead of the budget?
Two things. One is that exhaust your ATC, entitlement. Whatever be, if you, because tax save is money earned. So ATC, choose a tax saving fund, invest whatever. If you are left with 20,000 rupees which you can invest and that could be deducted from your income for computing taxes, go ahead and do it. Likewise, if you have additional 50,000 rupee savings, avail that from ATCCD, the NPS. NPS has improved. Choose a fund there. Have a 75% allocation to equity. Keep doing it. Tax save is money earned, and use it use all your entitlement to save on taxes. And this is the only methodical window available to individuals. They can't escape. They don't have much room to plan their taxes. This is the only way to go about it.